Hi, have a good day. I'm DNA. So we are again with the second video. In my first video, I explained about consolidation fundamentals, which are really essential to progress. Then we are moving on to calculation of goodwill on consolidation. So we'll move on to our video. In this video, I'm going to first talk about basic consolidation and then calculation of goodwill. So when moving on to basic consolidation, if we take an example, right? Company P, there's a company called P acquires S. Company P acquires S, and it's very importantly, P purchased all the shares of S, all the shares. That means P has acquired 100% of company S. P has acquired 100% of company S. How to find out? If P has purchased all the shares of S, it gives 100% acquisition. So it's clear, right? When you acquire one company 100%, right? You can control that company. So P can control S because you have fully acquired it. So P can control S. Okay. As we already learned, P is known as parent. P is known as parent, and S here, when you have the controlling power, when P can control S, P is known as subsidiary. P is known as subsidiary. Sorry, S is known as subsidiary. When P can control S fully, S is known as subsidiary. The other company is known as subsidiary. Okay, so we'll move on to the same example here, and we'll consolidate these two financial statements and see. Right. Before that, you have to note one important thing. In any of the consolidated financial statements of financial position you get, right, you have to look at these two dates. One date is acquisition date. On top you can see acquisition date, the effective date of acquisition, effective date of P acquired S. Effective date is 31st December 2018 in this example. Okay. Then what is the end of reporting period? That I have explained already in my fundamentals. End of reporting period is the end of the current reporting period. That means we are preparing financial statements. So we are preparing financial statements for 31st December 2018. So the end of reporting period, 31st December 2018, acquisition date, 31st December 2018, both are same in this example. Acquisition date same, end of reporting period same. That means the date you acquired, you are preparing financial statements, right? So with this 15,000 in the subsidiary company, S company, 15,000 retained earnings, right? They have generated before the acquisition, pre-acquisition reserves. This also I have already explained, right? 15,000 pre-acquisition reserves. Reserves generated before the acquisition date. Okay. So what is the value of this company? S. P acquired S. So S company has a value of 25,000, as I have already explained. 25,000 total value of equity is the value of the company. Okay, that means this company, if P tries to acquire this company, P has to pay 25,000 because the owner's value, owner's belonging of this company is 25,000. So we'll see how much has P paid to acquire S. P has paid 25,000 to acquire S. That means exactly the value of S. So with this relationship, you can clearly understand, right, that P has paid, that is P's investment. You can see it is the investment. P's investment is 25,000 on S. So S's value at that date is 25,000 as well. So 25,000 paid and acquired 25,000 worth company. Okay. So we are moving on to the preparation of financial statement now. We'll see how to prepare this group financial statement. Consolidated financial statement is the financial statement prepared for the entire group. Now this is P and S group, one group, because P acquired S. For the entire group, if you prepare financial statement. Now you can see P company has property, plant and equipment. S company also has property, plant and equipment. So if you look at the entire P and S group, right, it should be simply the addition of these two. When you add these two, you add P's property, plant and equipment and S property, plant and equipment, total is 80,000. Okay, so that's the total for the group. Very simple, right? Then current assets, if you look at current assets, also 45,000 P, 18,000 S, and it is total 63,000. Okay, if you move on to current liabilities, it's 30,000 and 13,000, total of 43,000, right? And again, we are moving on to this 25,000 you paid and acquired 25,000 worth assets. Now, when P is there and S is there, P acquires S, they become a group. So P paid 25,000, company S had 25,000 worth equity. When they become a group, this investment and the value gets cancelled off. Now they are a group. That's why you can't see investment value in the consolidated statement of financial position. Consolidated statement of financial position, we do not show the investment of the parent, because parent and subsidiary both we show, the investment gets cancelled off with the amount invested in S, or the value of S, pre-acquisition reserves plus share capital of S. 25,000 value of S, invested 25,000, it gets cancelled off. Remember this, when you prepare financial statements, investment gets cancelled off with the share capital and pre-acquisition reserves. Okay, this is a memorizing point, right? So since this 10,000 and 15,000, look at this 10,000 and 15,000. Since this 10,000 and 15,000, share capital of S, pre-acquisition reserves of S gets cancelled off, right? As the share capital of consolidated financial statement, only this 50,000 we show. So in the consolidated statement of financial position, we put this 50,000. And since this 15,000 also gets cancelled off, as the retained earnings also, we show only this 50,000. Okay, so the total of assets, total of equity plus liabilities in the statement of financial position, this gives you the consolidated statement of financial position. Okay, one point I would like you to remember or notice here, share capital is only parent company share capital. Share capital is only parent company share capital. And retained earnings, consolidated reserves, also parent company reserves in this example, because S company reserves, so the retained earnings, P company has paid and purchased. Okay, it won't come into consolidated one. So mainly two things to notice here. One is investment gets cancelled off. You don't put the investment in consolidated financial statement. And then share capital is only parent company share capital. Those are the two things to remember. And in this example, right, those two things earlier I said, investment gets cancelled off and the share capital is parent company share capital is valid for any consolidated financial statement, any consolidated statement of financial position. There's one more thing that is unique for this example. Retained earnings, only parent company retained earnings, since the other company has only pre-acquisition reserves and P has paid for it. Okay, now we'll move on to another example. Similar example with similar financial statement, right? X has acquired Y here. I want you to try this out. Pause this video for 5 minutes. Just for 5 minutes, pause this and take a small sheet of paper, right? And roughly calculate this and prepare consolidated statement of financial statement. It takes only 5 minutes. Very simple, right? Now pause this and try it out. Okay, if you have done it, we'll see the answer. X company has acquired again Y here, right? And X purchased all the shares of Y, that means 100% acquisition. It gives you controlling power. X is called parent, Y is called subsidiary. Okay, if you move on to the calculation, again you have to note acquisition date and end of reporting period. Here also they are same. Acquisition date and end of reporting period, both are same. Pre-acquisition reserves of the subsidiary Y company. Value of the company, in this case it is 40,000. Again you can see we have exactly paid 40,000, or X has paid 40,000 to acquire Y, right? That's shown here with this relationship. 40,000 investment, 40,000 value of the company gets cancelled off, as I explained earlier. In preparing financial statements, total of X and Y, property, plant and equipment, total of current assets, X, Y, total, current liabilities, X, Y, total or consolidated, and then share capital is only parent company share capital. Reason, investment gets cancelled off with the subsidiary companies share capital and pre-acquisition reserves. Pre-acquisition reserves, that is very important. Not just retained earnings or not just reserves, pre-acquisition reserves. Okay, later we'll come across something called post-acquisition reserves also, that I explained in fundamentals video. Okay, so post-acquisition reserve, when post-acquisition reserves are there, when post-acquisition reserves are there, the treatment is somewhat different. We'll see. Okay, so share capital is only parent company share capital, as I explained here. This 50,000, always it is parent company share capital only. In this example, retained earnings is also parent company, because the subsidiary company's retained earnings are all pre-acquisition and we have paid for it. Okay, so the total of assets, total of equity plus liabilities, very simple, right? Now we'll move on to the calculation of goodwill. Goodwill on consolidation, right? When it comes to goodwill on consolidation, we'll take an example again. Now company C acquires company D. Company C has acquired company D. And again, C acquired 100% of the equity shares of D. All the equity shares again, company C has acquired of D, right? So it is 100% acquisition again, and it gives controlling power. This is parent, this is subsidiary. Okay. So same example here. Acquisition date, end of reporting period. Acquisition date, end of reporting period. Same date, 31st December 2016, 31st December 2016. There will be questions, future coming, right? Acquisition date different, end of reporting period different. For simplicity, in the beginning, we are taking both dates same. Okay, because otherwise it will add further complexities. We'll be discussing those complexities with later examples. Okay, so acquisition date same, and pre-acquisition reserves here 30,000, pre-acquisition reserves 30,000, value of the company 40,000, value of the company 40,000, right? Now you can see here one special thing. I want you to have your attention on this 50,000. Here, see, the investment here is 50,000, but the value of the company is 40,000. Why? Investment is different now. Investment is higher. Why? Company D's value is 40,000. That means, say, if we are in company C, we would like to go and acquire company D. We go and try to acquire company D, and we are willing to pay them 40,000. We say, okay, we are willing to pay you 40,000. Company D would say, no. We can't accept only 40,000. We want more, because we have been in this industry for some time. Okay. We have good relationship with our suppliers. We have good relationship with our customers. They know us. They know our products, right? And we have a good employee base. Skilled employees are there. So when you buy our company, even though the net assets value or the equity value is only just 40,000, right? You will find it really smooth to run our operations, because we have been working in this industry for a long time. We are an established company. So we have a good name in the industry. So for that good name, we need some additional amount. So our company value is $40,000, yes, but we need extra 10,000. So that 50,000 investment to buy a 40,000 worth company, 40,000 worth equity company, right? That additional 10,000 you have paid is goodwill. Without even calculation, now you can see, right? We'll later calculate that also, right? Without even calculation, you can say that 10,000 is the goodwill here. Okay, right? So we'll move on to the calculation now. Again, company C, property, plant and equipment, D, property, plant and equipment, consolidated one. Current assets, C plus D, consolidated. Current liabilities, C plus D and consolidated. Share capital is parent company share capital. Retained earnings here also, in this example also, parent company retained earnings, because we have paid for the pre-acquisition reserves, right? Then calculation of goodwill. Here goodwill, it should be treated as a non-current asset. Under non-current assets, we are moving on to a working, and we open up that working, and fair value of investment. That means simply the market value. Understand it in that way for now. Market value of the investment. So it is shown in the financial statement. Market value of the investment is 50,000. So it is 50,000. And market value of the value of net assets, fair value of net assets, market value of equity. So that is 10,000 plus, that is share capital plus reserves, share capital plus retained earnings, pre-acquisition reserves here, 40,000. So 50,000 minus 40,000, it gives you 10,000 goodwill. Very simple. There are further complexities into these workings added later, right? So for now, it's a very simple calculation, goodwill, and we can put it in the consolidated statement of financial position. Total of assets, total of equity plus liabilities. So that's the goodwill of C and D group, and how to prepare consolidated statement of financial position for C and D group. Okay, we'll move on to another example, and again in the same way as basic consolidation, I want you to try this out. Pause this video for 5 minutes, take a rough sheet and quickly consolidate with the goodwill. Okay, if you have done it, we'll move on to the calculation. And here company L has acquired company M, again 100% acquisition. It gives you controlling power. L is parent, M is subsidiary, right? Same question. Acquisition date 31st December 2019, same date, end of reporting period. This is pre-acquisition reserves, right? In future examples, this may not be pre-acquisition reserves. Now it is pre-acquisition reserves since the acquisition date and end of reporting period are both same. If both are not same, this is not pre-acquisition reserves. We'll see that later. Okay. For now, it is pre-acquisition reserves. And the value of the company, 30,000 here. Value of the company 30,000. Your investment here 35,000. Okay, 35,000 invested. The value of the company 30,000. 35,000 investment, value of the company 30,000. So you have paid an additional 5,000 to acquire this company. So that should be the goodwill. We'll see. Financial statement. Company L and company M, consolidated one. Current assets L, M, consolidated, and current liabilities L, M, consolidated. And then share capital is only parent company share capital here. Share capital, parent company share capital. Retained earnings in this example also parent company retained earnings. And goodwill calculation in a working one. Fair value of investment 35,000 in this example, and the fair value of net assets here in this example 30,000. So 5,000 goodwill. You can put it here in the consolidated statement of financial position. Total value of assets and total value of equity plus liabilities. It completes the consolidated statement of financial position with goodwill calculation. Okay, so in this video I'm going to calculate only up to this point, and with further adjustments we'll see later. We'll see the learning points, right? We had in this learning points, Share capital in the consolidated statement of financial position is only parent company share capital. Share capital is only parent company share capital. Remember, this is always true for any consolidated financial statement. This is true, right? Generally, parent company acquiring more than 50%. That is very important point. We acquired 100%, so it gave us controlling power, right? But when you acquire more than 50%, it gives you controlling power. More than 50%, roughly. There are some other conditions as well. Okay, there are some more conditions. Not only more than 50%, those are advanced things. So for now, more than 50% acquisition, more than half of the acquisition of shares. You acquired shares, say for an example, 51% or 60% or 70%. Roughly says it gives you controlling power. So you are parent, the other company is subsidiary. Okay. When there's controlling power, the other company is called subsidiary, that we know already. Learning points. Investment gets cancelled off with share capital and pre-acquisition reserves. Investment gets cancelled off with share capital and pre-acquisition reserves. Okay. Goodwill is the difference between price paid. Price paid means investment. You have paid, the parent has paid a price to acquire the other company. The difference between price paid and the fair value of net assets. Net assets means equity. Fair value of net assets both. That's the goodwill. So if you have paid 40,000 and the other company has 30,000 net assets, 10,000 goodwill. Or if you have paid 35,000, the other company has 30,000, 5,000 goodwill. Positive goodwill. Now, so far what we calculated is positive goodwill. Why I have put here in the learning points positive goodwill? Because in the future there's something called negative goodwill as well. Okay, so we'll see. Positive goodwill, what we calculated so far. So that positive goodwill, right, is where your price paid is higher than the equity. Now equity 30,000, you have paid a price of 35,000. Equity 30,000, you have paid a price of 35,000. So 5,000 goodwill, positive goodwill. Okay, when the price paid is higher, you have paid more to acquire that company. Positive goodwill is treated as a non-current asset. You already know, we put it under non-current assets. Okay. So that's the end of this video. We'll meet with another video. Have a nice day.